second in our 2021 series. All of them are entitled How to Impress Investors. The first one was a couple months ago. It was How to Impress Investors with Your Financials. In September, we're going to have one that's going to be How to Impress Investors with Your Team. Today's topic is How to Impress Investors with Your Startup's Traction. And I'm going to introduce Timber Shea. She's the Venture Portfolio Manager at Invest Detroit Ventures, and she's also an NEF board member. And she was instrumental in putting this panel together, getting these experts together, and we're very proud to have them here. Timber?
Thank you, David. Appreciate it. So happy to be here. So David did my introduction for me. So let me tell you, let's start with a little housekeeping first. So we're going to do Q&A at the end of the panel. So if you drop that in like you've been doing so beautifully in the Q&A at the bottom, we'll start looking at those as we get closer to that time. Pop those at any time during the presentation and the discussion. So let me tell you a little bit about us, ID Ventures. We provide early stage investment to promising Michigan-based high-tech startups, as well as programming that helps strengthen the ecosystem. Since 2009, we've invested in over 170 companies with 16 exits. We've deployed more than $21 million through multiple funds and leveraged over $1 billion in additional investment. Today, I'm honored to be able to introduce my friend and colleague, Martin Dober. He's our Senior Vice President at Invest Detroit and the Managing Director at ID Ventures. He's going to be moderating this fantastic panel that we put together today. A little bit about Martin. If you don't know him, you should. Martin joined ID Ventures in 2013 with more than 18 years of experience in early stage technology ventures and in corporate finance, mergers and acquisitions, and investment roles. His primary responsibility today is to provide investment capital and support to early stage and high growth companies in the state of Michigan. Previous to that, Martin was the Senior Vice President of Entrepreneurship and Innovation for the Michigan Economic Development Corporation. He directed technology investment programs under the state's 21st Century Jobs Fund. Prior to that, he held senior positions in several small technology companies, including iRobot Corporation, American Systems Technology, and EIP, and served as startup tech consultant at the Michigan Small Business Development Center. We have a lot of connection there today, don't we? Martin serves as co-president and board member for the Harvard Business School Club of Michigan. He holds director and board observer positions for multiple portfolio companies. He's received his bachelor's degree in mechanical engineering with a minor in computer science from Kettering and his MBA from Harvard. And so thrilled that he's here today. Welcome, Martin.
Well, thanks for that nice intro, Timber, and really nice to see so many friends in the audience. Well, I can't actually see you, but I see your names, because this is Zoom. Really nice that we have so many participants here today. And I'm really enjoying this panel that we've been able to put together for you. So I was going to start with introducing myself, but Timber already did that. So I think she covered everything, everything pretty much about me. I have been with ID Ventures for almost the last 8 years, so I've been able to participate in that time in hundreds of deals that we've done over that time. So we have gotten really active in investing in the state. We invest in, now multiple companies per month, and it's just been amazing to work at ID Ventures and see the growth of what we've been able to do to support startup companies in Michigan now with over 160 companies in our portfolio, all Michigan-based companies. So it's been a lot of fun in these last 8 years. I would like to introduce everyone to our wonderful panel today. And what we've tried to assemble is a panel of entrepreneurs and investors at different stages of growth of companies so that we can really talk about the traction that investors expect to see and that startups should expect to demonstrate at various stages. And so we'll have some conversations about that today. As we do that, let me start things off by introducing our panelists. And I'm going to start off with Terrence. Terrence, can you do a short intro of yourself?
No, thanks, Morgan. I would much rather have Timber introduce me like she introduced you. but I'll settle for a self-introduction. Let's make sure we take care of that on the front end next time. But disclaimer, I am under the weather today, so if I turn off my mic or my camera, it's because I don't want the audience to see me wiping my nose or sneezing. But I am a former angel-backed entrepreneur for a company I started way back in 2012 called Networking Out. Eventually we failed, and so I returned back to my day job as a venture capital attorney supporting the area's entrepreneurs who are looking to really sort of disrupt various sort of industries. So I am fairly industry agnostic as an attorney, serve as the venture capital lead at Frost Brown Todd, a national law firm, over 500 attorneys. But I get the benefit of really pursuing my passion, which is as an angel investor, putting money and supporting innovation with really talented founders. And so I am a investor, serve as the board chairman of Irish Angels based out of Chicago, and also just recently co-founded Commune Angels, which is a angel group focused on increasing the diversity and inclusion in angel investing in the capital we place in portfolio companies. So I'm in the unique position of having sat at really all seats around the table as a entrepreneur, as an investor, and as a attorney who has represented both a company in funds on transactions. So excited to be here.
Thank you, Terrence. Really glad to have you here today. I'm going to turn it over to Jeff Mason for a self-introduction as well. Jeff, can you take it over?
Yeah, thanks, Martin and Terrence. Nice to, well, we did see you. I think we know you're there somewhere. But yeah, I'm Jeff Mason, the founder, CEO of Groundspeed Analytics. We just closed a Series C round led by Insight Partners out of New York with returning investor Oak HCFT in December of 2020. We're an insurance technology company, an insurtech firm. I've spent the better part of 20 years leading and creating high growth insurance and insurance technology companies. MBA from Michigan, and worked with both Spark and NEF in the past, and really happy to be here.
Thank you, Jeff. We're going to turn it over to our next panelist, which is Nestor. Nestor, can you introduce yourself, please?
Yes, thank you, Martin. I'm Nestor Lopez-Duran. I'm currently a professor at the University of Michigan, so I fit under the category of an academic founder. I'm also the founder of Ripple Science, it's a technology company in the clinical trials management space. We are about 3 years old. We did a large seed round a little over a year ago, and we are getting ready to do an A round next year.
Awesome, thanks, Nestor. And last we have Katie. Katie, can you do an introduction, please?
Sure, thanks, Martin. Hi, everyone, glad to be here. Katie Hall, born and raised Michigander. I also went to the University of Michigan's policy school, Go Blue, and then did my MBA at MIT. I've worked in the public sector most of my career, and then spent 7 years with a 501c3 that does workforce development, which is where the idea for Claira, my company, came from. So Claira is a competency matching marketplace, competency analytics engine that removes job descriptions, resumes, and all the other broken things from the current hiring process. I like to say that I hate inequality, but I hate inefficiency even more. And so I looked around after my years in Michigan, watching what happened in Detroit and working in workforce development just outside Detroit, and thought there must be a better way to connect people to work based on just the value they can add that will actually keep pace with the digital economy. And we know that technology is good enough to do just that. So we just finished almost finished a $700,000 pre-seed. We will likely oversubscribe that a little bit. We'll probably go up to about 850. So that was our first institutional raise. And we have an awesome team. And since I just went through this, traction is still very much top of mind. So happy to be here.
Awesome. So as everyone can see, we have a really, really good panel here, and I have the honor of moderating this. So I'm sure this is going to be some really good conversation, but I'd like to get things started. we're going to talk about how to demonstrate and how to impress investors. But I think what's really important in order to do that is, how to impress customers and actually getting a first customer. Having customers in place and getting some traction there obviously is going to go a long way with any investor. So I'd like some of our panelists to comment on just like, how did you secure that first customer and what was that process like? And just give us some experience around that and some learnings about that. Who wants to go first?
I can go. So what happened to me is just as a background, I developed this software primarily for managing participants in clinical studies in my laboratory. That was where the software came from. And then a few other people at the university began using the software. And it was mostly me piloting this MVP type of product. And at some point, we decided, me and my co-founder decided that we wanted to spin it out and see if there was a place in the marketplace for it. And we went through the entire process of licensing the technology from the university since it was developed in my lab. So that took a while. It was like about a year waiting for the license to come out. And during that year, I got really, really lucky that one particular event happened that became very significant, which was in a group. And to this day, I don't really know if it was a Facebook group or some other online forum where a lot of academic researchers congregate to talk about different things. Somebody asked, what software do you guys use to manage participants? Somebody says, well, I know about this software that is at the University of Michigan, but I don't know how to get it. And that was my software. And all of a sudden I got an email, and then I began getting emails from all these people because somebody put my name in the list. So I was really lucky that by the time that the license came out of the university and we signed the license, that day we launched the next day. And we had a list of about 8 customers that were ready to pay for it because they had been waiting, and we told them, well, we cannot offer it yet. We are waiting for the licensing from the university. So I got lucky in that I didn't have to really go out and like beg people to use it because somebody did that work for me in some online forum, and so they were ready to pay. And that really, really helped in that as soon as we launched, we already had people that were willing to pay for the product.
Jeff or Katie, any first customer experiences you can share?
Yeah, sure, I can go. From the start, I didn't give away anything for free. It was just a decision I made early on. There was a number of companies that we were prospecting, or I was. I mean, it was just a couple of us in the first months that were interested in trying out Groundspeed if we gave them, the software on a POC or some term that included some, basically, free period. And I just made a decision really early on never to do that. And so you run up against customer objections pretty quickly when you don't give away stuff for free and you're untested. So I resorted to begging, and really that's before I guess it was our Series A. I just knew how important it was to be post revenue, and I contacted the companies that were interested in buying Groundspeed, and I was just pretty clear about how important it was for us to be post revenue, and then we crafted favorable subscription terms for them, which equates to just really inexpensive. So our first customer, which is so we were founded in 2016. Our first customer was maybe 6 months into 2016, is still with Groundspeed and has expanded to other companies in its Berkeley, WR Berkeley insurance company. So, I think my recommendation, and this is not just from Groundspeed, from my career prior to Groundspeed is if you don't value your, whatever your service offering is, your product, your software, no one else is going to, right? And so I would recommend that you fight tooth and nail not to, give in to this assumption by the counterparties that they're going to get something for free. So yeah, so that's my first customer story. I used the tactic of begging.
Really interesting. Nestor and Katie, like that whole experience of, customers wanting things for free. Have you run into that as well? And how have you dealt with those requests?
Yeah, this is a tricky one. And we're all software, I think, and I'm probably the earliest company of all of us. And we have an enterprise, we have enterprise software, and we also have a live marketplace. So marketplaces are sort of their own interesting beast as far as the free versus not free discussion. For our very first customer, I actually, I came up with this idea when I was in workforce development. So I was working in the field, implementing competency-based hiring and competency analytics, basically as a consultant. And so I was testing the idea for the company out in the field to see what the demand would be like if I were to turn it into software. And so then after companies said, absolutely, if you make it software, we'll buy it, I wrote them down. And then when we built the software, I went back to them and said, remember how you said you wanted this? I made it a business. Now I want you to sign up for a super discounted subscription, was basically what I said. So our first customer signed a really deeply discounted 12-month subscription to use the marketplace, which was the first version of the product. That was the first product we launched last year. But I sort of listened to the market and kept track of where I knew the demand was. And then I made sure to go back to them because I figured they'd sort of be easier targets since they'd already committed. So we went for the super discounted version and a longer term for that first customer. On the hiring marketplace, it's free for workers right now. So for talent to come in and try to get jobs, it's free. And they're sort of a different beast than selling into businesses, right? Or enterprises. We also gave the employer side of the marketplace away in the early days because the metric we cared about most at the beginning was numbers of users because we need their data. So for us, the trade-off was worth it in the early days. Now companies of all sizes are paying, only 6 months after MVP.
So one thing that we encounter often, we still encounter, we never encounter a situation where customers wanted the software for free in terms of asking us, is there a free version? Mostly because this is highly secure, HIPAA compliant. There's a lot of compliance issues. So most often the type of customers that try to get our software are not, it's not a consumer product, and they are usually not understand that they're not going to get it for free, but they do ask for a free trial often. And we refuse to do free trials from the beginning. We just say no, that we were not going to do that. And we didn't do free trials because the way that these softwares are onboarded, they require some investments from the team. And the free trial in the type of software that we have, and we never tested that, but we have enough kind of history from other software that are in the similar space, that when you have a free trial, the moment that there is an additional kind of demand from the customer side of having to make more investment, time investment, it's easy for them to abandon the onboarding process because they didn't pay for anything. So it's kind of easy to just set it aside. But when they pay from the beginning, everybody within the organization is invested in getting value out of the thing that they pay. And the onboarding process goes faster, and that means that they get a much more value from it, and we get value because then we have less chance of churn. So that's why we never did a free trial. The only thing that we have done is a money back guaranteed within a number of X months, that if they cancel the subscription within that month, it's kind of like a replay. It's a different semantics of what a free trial is, but cognitively it actually works in how people interpret that. And we, in our entire history, we only had one customer that canceled the subscription during that free money back guaranteed phase. And that's when we knew from the start that they were a really bad match for our software. And we knew from the start that it was a very high risk churn, and we were not surprised.
You also get to book the ARR under that scenario,
yeah.
right? Which is really important.
Yeah.
I think Katie was talking about other value. And so if we're a data science company as well. So there's other value than just revenue, and getting either, showing traction with user signups, or if there's value in the data itself, then that's also important consideration. So it's not as stark as you need revenue in order to raise, but it helps.
So how did the early traction you guys were able to demonstrate, how did that turn into investor commitments? So I'd like to hear some comments from the group. Obviously, getting those early customers is really important. Getting an investor to commit is really important. And once one commits, it makes it a whole lot easier to get other investors to commit, because we all kind of follow each other and do what everyone else does. So how can you tell me a little bit about how you were able to get that first investor commitment? Who wants to jump in?
I'll go first. Yeah, so, and again, I think I'm the earliest, so we just did this. We just went through this in the spring. And I think Martin's totally right? This is what you do all the time. So we knew that once we got either, a term sheet or a commitment, and we were able to cite that we had a commitment or two commitments, that the rest would follow. And that's basically what happened. And it came together really quickly. Once we got Invest Detroit and two others who all basically came in. So there was one in, and then we knew if we got Invest Detroit in Michigan, that would be huge for us. So, we've done a lot of research and targeted partners really strategically, which, is tough when it's your first raise, because you need capital, period. But you also need good partners because it's a marriage and all that. I think the thing that brought it together was momentum is a real thing for early stage, right? And so if you're looking at companies that are this early, what are the, revenue, of course, is great. User numbers are great. But what are the other signals that the market cares about what you're doing, right? That there really are going to be buyers for what you're building. So we brought a really high-powered and senior team together and launched an MVP and three subsequent versions of the software on 46 grand over 10 months. So we were able to tell a story about how we operated really lean and built very strategically for what we knew the market wanted. We were able to show really rapid growth on the worker side of the marketplace. So, investors are thinking about risk, right? And so what are the things that you're going to say about your business that are going to tip the scales so that you're, just risky enough that they're comfortable investing? Marketplaces are scary. I think marketplaces scared off a lot of our early investors. They're time and capital intensive to build. And so we knew that our ability to get talent on the marketplace with all the other noise about job sites was the thing that was going to be really important for that product. So we had workers online and getting matched to jobs within an hour of launching the MVP. And then we were signing up 30 to 80 a day after the launch of the MVP. So that was a really powerful growth story to tell. That was a key traction metric for us. And then I think the other thing that did it for flipping our first investor was in January, when we decided, we're getting a lot of demand from larger enterprises. We're just going to start building the enterprise software right now and signing up those customers. The software we built for MVP did 80% of the job for enterprise. Once we were able to kind of de-risk the marketplace product with the enterprise product at the same time, that's, I think, what tipped the scales for our round.
Yeah, let's keep going on that. And I want to actually remind the audience that we will be taking Q&A with the panel. So if people want to start putting in some questions in the Q&A, I know we have about another 20 minutes left, but feel free to do that at any time. But on the kind of securing those investors, maybe Terrence or Jeff or Nestor, and I'll jump in on this too, but what were some of the things that, maybe investors were looking for at various stages of growth in the company? I think what we'd like to give an indication, obviously things change, whether you're doing pre-seed or seed or Series A investing and beyond, but let's have a conversation around what are some of the things that maybe some investors told you that they needed to see in order for them to commit or for them to come in later. Or what were some of the things that you guys heard?
I guess I can take that if you don't mind. So I think I'm 4 rounds now into this. So I have some benefit of hindsight, and the market's changed over that time. I mean, I'm in InsurTech, and when I launched Groundspeed, InsurTech as sort of a phenomenon of capital attraction had really just begun, and now it's a well-established vertical. Certainly where we are at post Series C, a Series C company, what they're really interested in, and what people have told me is TAM, is that there is a big TAM, right? So that's something that I found, well, I didn't know in the beginning, right? So I built out everything else, and I didn't spend a whole lot of time with establishing and developing what the total addressable market was. And what I understand, at least from this most recent round, what they're really looking for, and this is a lot of people I think probably know this, is they're just putting their bets in on, they'll put their bets in on 20 companies, and if 1 or 2 of them hit, they've made the fund, right? So they want you to demonstrate that this is a large market that you're attacking. Even if you have a really good solution for a small market, you're just going to struggle to raise in the environment that at least I'm seeing. And it really, I think, Martin, I mean, you probably have experienced this. It really depends on where you're raising from as well. So we raise, all of our monies come from New York, but I think New York is different than the Bay Area and how they. I know this is being recorded, so I can't say too much about the differences, but there are pretty significant differences in whether you're more, I don't know, vision based or you're more kind of financial fundamental based. And I think what I found is that New York venture capital is much more interested in making it, having a reasonable, fundamental financial model, as well as the TAM. While in the Bay Area, it's largely about having a huge idea, right, and a massive TAM without as much concentration on the financials and kind of the unit economics.
Yeah, Martin, I can jump in here, and I'm really sort of interested in your thoughts too. I think sometimes when we say traction, it's really not clear exactly what we mean. And so for me, I like to decode it into what does it take for the founder to convince me that this is a good investment? And there's 2 components to that for me. One is about the business, and you underlie it with the team, the market opportunity, the customers, the revenue, and the unit economics. The other part is extremely personal and subjective, me. And that traction is about the relationship between the investor and the founder. And so the better the relationship between the company and the investor, the more meaningful the information you share about the company becomes. And so for me, it's relationship first, and then I'll better appreciate what you're telling me about traction. But I do pre-seed and seed deals mostly as an investor, and I've done deals from the coast. And so Jeff, I totally agree with your assessment. When you do a Bay Area deal, it's how big of a vision is the founder painting. In New York deals are, what's the exit multiple? How big is the market? We're really talking numbers. But I think it is important to understand, to appreciate that traction is also includes the relationship between the company and the investors, because once you get one, everyone starts to sort of load in because we're really good at quick follows. But I'm absolutely looking at the pre-seed stage. I'm looking at, do we have founder market fit? Because at that stage, you may or may not have an MVP. And not only founder market fit, but is the founder nimble enough to change the direction of the company if the market is telling them something different? And so pre-seed, it's all about the jockey for me. There are no real fundamentals to the business outside of, are they providing a solution that meets a real problem? And how big is this potential market?
Yeah, I totally agree with that, Terrence. We're similar that we, because we invest so early into companies and generally at the pre-seed and seed stages, for us, it's certainly mostly about the entrepreneur and the team and the market, I would say. Those are the most important components in what we look at. We don't expect a lot of revenue at the time when we invest, but what we do expect to see is customer interest. And it doesn't mean that they have to be paying. It doesn't mean that, there has to be full enterprise deployments. It just means that we have to be able to talk to some customers or even potential customers and just say, hey, what do you think about this? And would this be something that you would buy? And that is something that's really important for us. Also, with just being a very early stage investor, what we always like to try to do when we're doing diligence on a company is talk to some of the later stage investors, some of the investors that would ideally be in the next round, and try to understand what are the things that you would be looking for in order to invest in a company. And that way we can help the companies that we invest in get on that path to secure rounds from these larger investors than us. So we always like to have those conversations with some of the investors down the road. Anyone else have experiences that they want to share with things investors have wanted to see, or metrics or specific metrics that you've seen in the marketplace for companies raising capital?
I'm not sure what they want to see now, but I do remember at the time when we were doing the first pre-seed, it was the months, I think 2 months after we launched, that we actually sat down. In one of them was the Invest Michigan office in Detroit. I sat down there with Patty and I gave my pitch. And I think at some point we had the conversation that one of the questions that always came up was the idea that if somebody wants to pay for, does somebody wants to pay for this? Is there really somebody who will willing to pay for this? And at the time we already had, I think it was 16 customers that I didn't know. And that was another question. Okay, somebody's paying for it, but is it your friends? Is it your neighbor who is paying for it? Is it like your uncle that you like forced to pay for it? And these were researchers in other universities that I didn't know at all that they were actually paying for it. And I think in terms of impressing investors at the time, I think there was something that worked for and against us at the same time, which was that it was a team of literally 2.5 people. It was me and my co-founder. Both of us had full-time jobs, and a half-time person that we had hired right out of the university that just graduated and was working with us, who is still at the company now. Is the director of customer success. And it was just the 3 of us, and none of us was full-time. So we had a company of 1 person working part-time for pay, the other 2 volunteering because it was the founders. But we already had 16 customers, and we were signing up customers pretty much a lot every month. So that really helped, especially with teams that could see past the fact that the two founders did not want to stay in the company because we had commitments to other jobs. In my case, the university, that I was very clear from the start that I was not going to leave the university. And that really hurt conversations with other type of investors. So I needed the money to get the initial team that was going to start full time, but I needed investors to be convinced that not having me as part of the full-time team was okay. Nobody was going to say it was a good idea, but it was a risk worth taking. But what really sold them was the number of customers that we were bringing in, and the fact that they were actually paying for the product.
And Martin, I believe we're talking mostly sort of SaaS, B2B sort of offerings here. And so the core sort of metrics that we're looking at are MRR, and I like to see pretty strong month-over-month growth. Say 10 to 20%, maybe may push for 25% depending on the sort of the company. But as I'm moving from sort of pre-seed to seed, I want to see at least a 2x multiple on the valuation of the company, which is going to be indicative of that MRR trend. It's also going to be reflective of sort of decreasing churn. And the sales cycle should also be starting to come down a little bit, even with those early indications of traction in product market fit.
Yeah, thanks, Terrence. And I've heard that I think we often tell companies, especially if you're going from a seed to Series A, trying to get to that $1 million ARR, at least in Michigan, has been the goal. And certainly there's some, can be less than that or more than that. I've read recently that a lot of investors, and maybe this is more on the coast or maybe in New York and the Bay Area, that's kind of jumped up to now like 1.5 or 2 million. Just wondering from the panel, if you've noticed like changes in the current environment with investors, particularly with COVID and how you interact with investors. Obviously, people are now meeting online, and we've done deals where we haven't actually met the entrepreneurs in person, which normally we'd like to do. How have things changed, maybe in the last year with just meeting with investors, with the current economy and with the pandemic?
So we have heard, I cannot say that it's true because we haven't tested it yet, but our plan was to do an 8 round next year. And we are now considering doing kind of like a small bridge to guarantee that we're not going to have trouble hitting the 8 round level. And in our last board meeting, it was recommended that we consider the possibility of moving the 8 round earlier and actually going ahead and doing the 8 round now, even though we are not quite yet at the 1 million ARR. Because the understanding is that the appetite and the amount is high right now, and the amount of money in the field is very high, and so some companies that have gone out to do small bridges have ended up raising a lot more than they needed for the bridge, and they converted into a full 8 round. Now, I'm hoping that that's true, and I'm hoping that it happens to us, and it's a great development if it's true, but we'll see.
Yeah, I mean, it's a seller's market right now. I mean, Terrence, you're talking about 10% month over month growth to get from seed to Series A or pre-seed to seed. I mean, if you have 10% month over month growth, just fly out to Oakland or something and you could raise 20 million right now, right? I mean, so I do know that there are some, funds in the Midwest that are, still have a pretty, I think, I don't know, one could say reasonable, another could say conservative approach to metrics, but yeah, I mean, there's a ton of money out there, and the multiples are really high. And if you could show, I mean, if you could show, I mean, what they want to see, right, is 2x, 3x like annual growth with addressing real customer need and a big TAM, you could go out and raise just a ton of money at a pretty high multiple right now. in my experience. So
You're right, Jeff, and it really is a function of the team as well. I think the last 3 deals I've invested in, 2 New York, 1 Midwest with Bay Area investors, all of those companies had less than 1 million, and the valuations were 24.5, 55, and $15 million post money safe. And so the market is so hot right now with capital that it really is a seller's market.
yeah, and it's about, I like what you said, Martin, about, no, it was Terrence. I think it was Terrence talked about like getting along with the founder, right, the investor. I found that's, I mean, we have just great investors, and I consider them really good friends. And you know, there's just a level of trust in both ways that are really helpful. And I think for you know, early stage companies that are really just, you know, looking for anybody to ask them out, right? I think it's really important to find that investor that really believes in you and that you get along well with, because you're gonna be working. I mean, they're gonna be, you know, your you know, best friend or your worst nightmare, right, for the next 10 years. But we've been really lucky with really great investors. So.
I want to get some questions again. I know we only have a few minutes left, but if anybody has any questions to put in the Q&A, feel free to do so. It looks like there's one in there about, you know, is it better to just forego a pre-seed round and go kind of straight and raise a larger seed round? We've kind of hinted on some of that a little bit in our conversation. Anyone have any thoughts on that?
It's marketing. It really is. You'll have smaller investors that want to call your pre-seed a Series A. That is not great for you as a founder. Or pre-seed, seed. There isn't a real. I don't know if you guys disagree with this, but there isn't like an amount of money that are tied to those categories, but there are some expectations when you go into B and C. And so if someone has marketed a seed as an A, then you're going into B, it's really an A, right? Then you have to somehow or another, you know, message that when you're fundraising, and it gets complicated. So I don't know, but I would always choose a lower round name, right? Because it allows you much greater latitude with if there's something about your momentum that doesn't quite work for the round.
I agree, especially if the pre-seed, if you need a smaller amount and you cannot get that larger amount at the traditional seed round. If you call it a C, the next step is an A, and you're very, very far from an A, and then you're going to end up doing some sort of bridge stage, and people are going to start looking at what that was. In my case, for example, we couldn't afford to do a seed round, and afford, it means like nobody was going to give us seed money because we didn't have a team. We just didn't have anybody in place. So we needed to get just enough money to put in place the full-time team that then we can go and raise a proper seed. And that worked very well. And the issue was the fact that we didn't have a full-time CEO. I was on sabbatical at the university, and I was acting as the CEO on the sabbatical, but my sabbatical was going to end. So we needed to have enough money to put the CEO in place to raise a proper seed. And we called it a pre-seed for that reason. And it worked very well because we got friendly investors that were willing to see past the fact that we didn't have a full-time team.
Yeah, I think Donovan's question also raises the question around whether you're talking to the right investors. It's important to appreciate that some investors are quick follows and some will be happy to sort of put money in first. And so I think the question is, who do you need to get committed in order to pull those other investors along to appreciate what the appropriate sort of pre-seed seed KPIs actually are. And so I would try sort of listening intently from those investors on what they're looking for. But you'll quickly find that if you pull an investor, especially one with a great reputation in, that the conversation changes extremely quickly. And so I think focusing on what investors you're talking to, what region of the country they're from, what the expectations are, is all part of the homework.
I think we're almost out of time, but we do have a couple of questions in the Q&A that ask about crowdfunding and that. And so I at least wanted to touch on those, and I'll invite Terrence and the other panelists to weigh in as well. Certainly, I think it's, for some companies, it's a good approach to look at crowdfunding, particularly if it's a B2C, I think, opportunity, because you're able to build your own customers that way. I think if you're going to try to raise both crowdfunding and venture capital, that's where it becomes an issue, because most venture capital firms will not, you just won't want that messy cap table and won't be interested in it. Also, sometimes the terms are a little funny. We have done an investment in a company, at least one company, that also did crowdfunding. And we really wanted to help them kick off their campaign and get them that additional capital. And it worked fine for them. I don't know that we would invest, additional dollars into it, but we did help to kind of get that company going through a crowdfunding campaign, and our initial dollars really helped them out. But I would invite anyone else to weigh in on crowdfunding considerations for entrepreneurs.
Yeah, no, I think crowdfunding is great, and I think it certainly allows non-accredited investors, especially, to sort of get into the capital game. But I think once you choose a path, you have to stick to it. Despite the sort of increasing popularity of crowdfunding, VCs are not sort of apt at this point to invest alongside. Even if you're doing Net Capital, Republic, and they're investing through SPV, so you only have one sort of line on the cap table, it's best to socialize the idea of a crowdfunding campaign with your intended investors to see how well it sits with them. And I've had a couple of clients over the last couple of months who have sort of had that conversation, and it's always turned out, don't do it or we won't invest again.
Mm-hmm. I also had that conversation with a couple of early investors. We sort of half looked at crowdfunding. I have a couple other founders in my network who used it very successfully, but they were both B2C brands, as Martin said, and we knew we were headed up market, B2B SaaS. We were getting so much energy on the worker side. We're targeting middle skilled workers. A lot of them were unemployed because of the pandemic. There was a lot of energy in our first worker group around a new way to connect people to work, especially since so many people were displaced. And so we thought maybe this is an opportunity to capture some capital using crowdfunding. So I asked a few investors who were advising me, and they were like, we're not coming in after that if you have crowdfunding on your cap table. So for anybody who's thinking about crowdfunding, though, it wasn't the best path for us, and we got lucky to get really good VC partners. But Maxine Tuchman, who founded Caribou, the app Caribou, went to Harvard's business school. I think she's in Miami right now. She raised a record-breaking crowdfunding round for her app, and then subsequently raised a VC round. So she's sort of an interesting case study for anyone who's looking at crowdfunding.
Look, I mean, if you have all the other metrics, people are going to be dying to get into your deal. It doesn't matter if you had crowdfunding, right? I mean, if you have all other things equal, though, VCs want a big stake, and they don't want complexity. And so, but certainly if you're a freight train, runaway freight train in growth, and I mean, everyone's going to want to get in, and they're not going to care about what the cap table looks like. It's just that they're on it, I think.
Well, I think that's about all the time we have for our panel. I really want to thank our panelists, Jeff, Katie, Nestor, Terrence. You guys did a fantastic job, I think, and really enjoyed the conversation. I hope the audience did as well.